You open up your phone and the financial advice hits you instantly. Push notifications, trading reels, influencer alerts, a high-speed, relentless digital feed demanding your attention and your capital. These digital interactions happen in milliseconds, but the rules governing what those companies can legally say to you were built for an era of paper filings and physical mail. Look at this diagram. It shows 6 distinct types of SEBI-regulated entities, from stockbrokers to mutual funds to investment advisors. Until now, they have all operated under completely different, overlapping rulebooks. If a firm is registered in multiple capacities, a single social media post might trigger conflicting guidelines and require separate approvals from different authorities. Applying a disjointed, multi-layered framework to instantaneous digital platforms breaks the system. Businesses struggle to market effectively, and retail investors are left trying to navigate the resulting noise. The primary source of this friction is the prior approval model. Under the old rules, many entities had to get individual social media posts cleared by an exchange or supervisory body before hitting publish. This timeline illustrates the fatal flaw of manual gatekeeping. A highly relevant, time-sensitive market update quickly loses its value while waiting days for a bureaucratic approval stamp. By the time it clears, the information is useless. Massive institutions can afford to absorb these delays, but for smaller entities and individual creators, this regulatory bottleneck actively inflates compliance costs and stifles their ability to compete. SEBI recognized the friction. To fix it, they proposed consolidating these fragmented codes into a unified system designed to operate at internet speed without sacrificing investor protection. Enter the proposed Common Advertisement Code, or CAC. It replaces the old entity-specific rules with a single set of standardized guidelines. The most significant shift in the CAC is the removal of the pre-issuance gatekeeper. Instead of waiting for permission, regulated entities operate on a 24-hour post-issuance reporting window. As this flowchart shows, a firm can publish immediately. The moment the post goes live, it triggers a 24-hour countdown to send the data to a central supervisory node. The regulator relies on tech-enabled post-activity monitoring rather than manual pre-approval. The CAC also updates the rules for short-format messaging. Think about an SMS or a push notification. You cannot fit 3 paragraphs of risk disclaimers onto a lock screen. To solve this limitation, the code allows that dense text to be replaced by a direct hyperlink leading to the full details. The architecture of compliance is now rewired. It matches the timing of regulatory oversight directly to the speed of modern digital communication. Then there is the loudest voice in the modern digital market, the celebrity endorsement and the financial influencer. Under the CAC, famous faces are legally permitted to endorse a firm's overarching brand. This allows companies to leverage visibility to build general public trust and drive financial inclusion. But as this split screen demonstrates, there is a hard boundary. Celebrities cannot endorse specific financial products or promise expected returns. They can tell you who to trust, but they cannot tell you what to buy. Because of the massive reach and potential risk involved, these celebrity brand campaigns are the one major exception to the new speed rules. They still require strict prior approval before airing. This bifurcated structure strikes a deliberate balance. It allows legitimate brand marketing to thrive, while aggressively protecting retail investors from hype-driven product peddling. The new code also creates a safe harbor for genuine educational content. Firms are no longer discouraged from posting basic financial literacy materials out of fear it will be flagged as an advertisement. But where education is protected, manipulation is explicitly banned. The CAC institutes a strict prohibition on digital dark patterns. Dark patterns are user interface designs built to deliberately subvert your autonomy. This means banning artificial countdown timers that create false urgency, forced actions, or hiding the cancellation button to create a subscription trap. Firms are also restricted in how they boast about their success. They can only use competitive ratings or rankings in their ads if those metrics are objectively verified by a specific designated agency known as PARVA. The CAC acts as a sophisticated digital filter. It strips out manipulative user interfaces and unverified subjective rankings, ensuring only genuine education and factual claims flow into the feed. This highly organized architecture is what SEBI envisions for the digital market. By unifying the code, a legacy asset manager and a brand new digital bond platform are held to the exact same behavioral standard. It removes the red tape of prior approval bottlenecks for legitimate businesses while weaponizing post-issuance monitoring to quickly identify and penalize bad actors. The internet is the permanent home of retail finance. With the Common Advertisement Code, the regulatory framework finally allows business innovation and absolute investor transparency to coexist directly on your timeline.